How to trade growth stocks with Brandon Chapman, okay, chartered market technician, of course, TheoTrade presentation, risk disclosure. We're not financial advisors or a broker dealer. Well, the reason we throw up the risk disclosure here is, normally, and again, I'm Don Kaufman, but normally I throw this up here and say, all right, I worked for 15 years in the brokerage industry prior, of course, to, co-founding TheoTrade. Brandon Chapman also had worked in the brokerage side of the industry, specifically at one of the divisions of TD Ameritrade, specifically in the education division of TD Ameritrade. So there is your lovely risk disclosure. No soliciting, no photography, and don't feed the monkeys. Copyright disclaimer. We have our address here, our telephone number, a support at TheoTrade.com. One of the things that I feel very strongly about, and I think you should too, well, we answer emails. Support at TheoTrade.com. We use a generalized inbox. If you need to get a hold of myself or roughly anybody here at TheoTrade and Brandon after this evening, just email us at support at TheoTrade.com. Just put the name into the email of whoever you're trying to contact, and we will assure you that we will get back to you, okay, within about 24-hour period of time. Obviously, some people are overseas and so forth, and emailing us at 3 a.m., though you'd be surprised, not too many of us sleep over here, so quick copyright disclaimer. Now, we're going to be introducing Brandon Chapman, and first and foremost, I want to welcome Brandon Chapman, of course, to TheoTrade. Brandon is our newest instructor here at TheoTrade, and we're actually thrilled to have him on board. Brandon came on. He is now the 7th full-time instructor here at TheoTrade. A couple of quick bullets over here. He's got over 20 years in the financial industry. Obviously, Brandon worked in the education division of TD Ameritrade, a division, of course, I knew well. It's a division that we kind of started many, many years ago. 7 million clients, of course, at TD Ameritrade at the time that we were there. Brandon's also, of course, been a Forbes contributor, okay? The SME for the CMT, if you have no idea what that is, okay, the Chartered Market Technician is a highly coveted position. It's an extraordinarily difficult, okay, certification to achieve. Brandon's actually a subject matter expert for the CMT. Effectively, what that means, he helps write the questions for those tests. He helps answer the questions for those tests. So the Chartered Market Technician Association actually turns to Brandon as one of the subject matter experts. Last but definitely not least, Brandon too has a little bit of thinkorswim platform experience. As I said, although we came from a background of both thinkorswim and TD Ameritrade, and Brandon was actually there as well when it was still thinkorswim, and went through the acquisition with all of us. Nevertheless, we are broker agnostic. That means we're pretty familiar with a lot of the different trading applications out there. One of the other important things here, a little bit about TheoTrade. We specialize in education stocks, options, futures. We're founded by professional traders. Everybody on our crew has a minimum of 15 years of experience, few of us with a couple of decades. And we're here to help you mitigate risks. It's first and foremost, and you're going to learn a skill set that'll last a lifetime. Last thing I want to mention before bringing on Brandon is that TheoTrade, as I was mentioning a moment ago, we are 7 full-time instructors deep. We're not this one-trick pony where there's one individual here that even stands out. Here are the TheoTrade instructors. We have Jeff Bierman. He's an analyst, a trader. He's the former chief technician for TD Ameritrade. So Jeff actually worked with me for, wow, almost 11 years now, kind of side by side. Jeff actually worked directly in my group. Specifically at both thinkorswim and TD Ameritrade. Matt Williamson, also one of the newer instructors here. And by the way, people always ask us, like, are you guys just going to keep adding more people? Yeah, why not? More instructors. I mean, we've got everything from Jeff Bierman, market technician. We've got Matt, of course. Matt's market neutral premium selling option strategist. We have Corey Rosenblum, senior strategist. He's kind of our resident swing trader. There's me. This is Don Kaufman. I'm the lead instructor here. My expertise lie in volatility, risk management, and what we'll call quant logic. That's quantitative logic. What does that mean? I'm a math geek. All right, admitting it's the first step today. We have Steve Miller, 43-year veteran options futures trader. And last but definitely not least, our intraday strategist, none other than Tony Rago, specializes specifically in Nasdaq futures. Now, without further ado, I am going to pass this, and it'll take just a moment. I'm going to pass this directly over to Brandon. So, Brandon, if you're there, welcome. And he's got it. You got to run with it.
Yeah, I got the ball. Hopefully, there's no fumble, right? I mean, 'tis the season.
No fumble, and I'm going to let you run with it by all means.
All right.
Thanks.
Yeah, a little nip in the air, right? Getting fall into winter. I don't want winter to come too soon. But anyway, hey, let's talk about what we're going to learn today, right? Because this is important, right? We're kind of laying the foundation. Of course, we're going to continue this in the weekend with our class, but we're going to talk about today what it takes to make a trading strategy successful, right? There's little different pieces to that puzzle. A lot of times as new traders, you find yourself, even people who've been in the market for a while, it can be hard to know, okay, what do I need to do to be successful? How do I identify a growth stock, right? And there's that tendency sometimes, okay, am I trading the type of stock I think I'm trading? What causes stock prices to increase in value? How to evaluate a management team's effectiveness. We're going to talk about analyst estimates, how to read them, and we're going to talk about how to set stops to let winners run and cut losses short. And of course, we're going to use moving average for swing and trend trading, okay? And at the end, we're going to wrap it up. We're going to use the TOS platform in the chart. We're going to look at an example of a stock and a little bit of the system behind how to trade it once you've identified those kinds of stocks. So let's kind of dig in here. So the first thing is, are you willing to put forth the effort, right? I mean, not everything is easy, right? A lot of things that are easy aren't necessarily worth it. There is that tendency for people to just be told what to do rather than being guided, right? What we're going to do is we're going to guide you in a direction that's going to help you be successful, but it's going to take some effort, okay? It takes trade logic, strategy, and trying to trade the right strategy with the right kind of stock, right? And that's an important thing, whether it's stocks or options. Or whatever you want to go. So let's talk about what I've learned. So as Don mentioned, I've been in the education industry for 15 years. I've literally talked with thousands of self-directed investors one-on-one on a phone call. I've taught a class on growth investing type strategies, like probably probably close to 1,500 or more different times, right? So I've done this many, many, many times over the last many years, okay? I've seen what works and what doesn't. What gets repeated, oftentimes what doesn't work tends to get repeated over and over again. Of course, people talk about, Einstein, whether he said this or not, Sanity's doing the same thing over and over again, expecting a different result. That happens a ton in trading, okay? And today we're going to discuss a consistent method for evaluating growth prospects for a stock and ways to trade it consistently. Consistency is very much the key in this approach. So let's talk. We'll kick it off with number one. Okay, number one. What makes a trading? What the number one criteria that makes a trading system successful? Success is dependent on matching the right system with the right kind of stock. I think there's a lot of times, we come up with some ideas of how to trade something, and we're not so good at sometimes picking the right kind of stock to apply it to. I really think it's a lot like putting square pegs in round holes. A lot of times when we're struggling as investors, as traders, we're trying to pound that square peg in round hole. In the past, people have spent thousands of dollars for a system, and you talk to them, and they want to take the stocks that they're familiar with, and they want you to trade. They want that stock to be the right kind of company. They're taking that square peg and they're pounding it as hard as they can into round holes, okay? What we want to do is we want to pick the right kind of stock to trade with the right system, right? That's a very important thing. An example of that, Proctor Gamble. Now let's give some information about or some details about Proctor Gamble, right? Number one, it's in the consumer non-cyclical sector. What that means is their earnings just don't vary a whole lot. Now recently they've had a couple of earnings that the stock's dropped a little bit, but the fact is that they're in the business of selling you the stuff that you're going to need, whether it's in boom times or recession. They have relatively stable earnings, low relative margins, other things. It's consumer non-cyclicals. It has a beta of 0.56, What does that tell you about a stock? It's about half as volatile as the S&P, and it pays you about a 3.5% dividend yield. Well, that's a nice kicker. I get 3.5% to hold the stock, but is this a good stock to trade? Think about that for a moment. I mean, there might be moments where Procter & Gamble has some potential to run. We'll talk about that here in a minute. But if I was looking to consistently trade Procter & Gamble, trading the stock for maybe a week or two or a few months, it's probably not the best stock that I'm going to pick, or you would pick per se, to really make money trading. Okay. Now, when you get to the option side of things, and when you're on the side, you'll see lots of people, different perspectives and strategies. I have kind of every day of the week, I hit a different topic. I had fundamentals on Thursday. We're always sprinkling in options a little bit, right? Options money, I spend talking about options. Now, stock like Procter & Gamble on the options side, you get the leverage, right? But when you're trading stock, it's not necessarily the best candidate. Again, it's about picking the right stock for the right system. So let's talk for a moment. So again, maybe if that's not the right stock most of the time, let's talk about what creates an environment for a stock to appreciate in value and trend. You know, one of the principles of charting and technical analysis, okay? What is it about? It's about getting in the early stages of a trend and playing it out to the end of the trend, right? Whether that's trends over a short period of time, an intermediate term period of time, or a longer period of time. The whole strategy of using charts is to play the trend, but what causes these trends? You know, I've really kind of centered on two fundamental reasons why a company or stock trends. Number one, valuation. Okay, and we'll talk about it from maybe a stock's trading at a discount to its perceived value. The other is earnings growth. Okay, and we'll kind of break down these individually, right? But earnings growth is something that is basically companies growing their earnings at a high rate. So let's talk a little bit deeper about this valuation subject, right? I don't know, any value shoppers out there? Anyone out there, you know, you love a sale. Unfortunately, I love a sale, right? I mean, I love shopping, right? I love going out there, you know, Sylvain says, who doesn't, right? Kim says, me. I love a good sale, right? Value stocks are about trying to find companies that are on sale, right? That are discounted, trading at a discount to their perceived value. One of the difficult things, though, is that how do you know whether a stock's trading at a discount? There's various models, and I've taught for years ways of evaluating it using discounted cash flow models and other things. But how do you know if a stock's trading at a discount? That's one thing that can be a little difficult. Steve says, I hate to shop. Do you like to shop for stocks? Do you like to trade? You're a shopper, right? Do you like to trade options or stock or futures, whatever the case is? You're a shopper. You may not want to go to the store, right? We're going to teach a little different kind of shopping today. Will it trade? Well, so the point is, if it's trading at a good valuation, right, will it trade higher until the discount's erased, right? So the point is that once that discount's erased, is the stock got legs to continue higher? It's going to take something more than that to continue to cause the trade to stock to trend higher beyond reaching that erased discount. On the other, sometimes it's a value trap, right? It looks like it's value, but internally there's things from a management perspective or earnings that inevitably kind of derail a company. So it may look like a good value, but earnings can be sometimes unstable. They might be deteriorating, and that's why the stock's trading lower. So you might be trapped by buying a stock because it's trading at a discount or perceived discount, but it doesn't necessarily get that traction to the upside to get that appreciation that's needed to make money when you're buying stock. But when we talk about earnings growth, what is it, right? A growth company, it has high projected future earnings. These stocks tend to trend perpetually, right? Has anyone watched a stock and it just keeps going up and up and up, and you keep watching it and you're thinking, okay, you know, well, I'm gonna wait for the stock to pull back here a little bit, right? And it doesn't. It just keeps going, and you feel like you've missed it. You've just watched that stock continue higher and higher and higher, and you're sitting back, you know, with your mouse in hand, waiting. And it just doesn't come back for a long time. You know, growth stocks tend to have that or exhibit those kinds of attributes, right? That trend tends to perpetually go on until eventually, as long as that outlook's maintained. Sometimes when the outlook changes, that would be me. Sometimes the outlook changes, that stock can go down, right? We got to know when to take our profits, which is one of our points here, okay? What makes a successful trading system? Well, a successful trading system requires proper trade management, okay? And what is proper trade management? Let's talk about that for one. You got to know when to enter and exit, right? I mean, there's that, old saying, those who fail to plan to fail, right? But there's some truth to that. I fundamentally believe, I just whacked my mic, almost wiped my head's off my face, but I fundamentally believe that people are rational, that people make rational decisions, that they're capable of doing it. But when we get into the market and we don't have a plan, our rational side can take hold, right? Our emotions can take hold. But if we go in with a plan and a commitment to trading that plan, you're going to put yourself in a position to be successful. Another point here is proper position sizing. I remember talking with a gentleman, it's probably 10 years ago now, but he called up, he's like, oh man, he's racking his brain. He's like, this just isn't working. I'm not making money. There's something wrong with the strategy I'm doing, okay? We talked about his strategy, talked about what he's doing. Seemed pretty reasonable based on what he had articulated and the examples that he had. He had 4 recent examples, 4 positions he was currently in. 3 of them were profitable and 1 was not. Well, guess what? That one position he was unprofitable on, his level of investment, he had more money in that one position, happened to be Apple. He had more money in Apple than he had in all the rest of the stocks combined, okay? So that's a problem, right? So again, he put himself in a position where his system couldn't work because he didn't do proper position sizing. So in order to be successful, we got to know when to buy, when to sell, and how much to buy, okay? I didn't make that up, but it is something that has to happen. It has to be there, okay? And now when we talk about entries and exits, when you talk to people, right, and they're getting into it, generally speaking, the first thing that people say is, well, I know when to get in, I just don't know when to get out. How many of you folks have ever felt that way? Feel like, I can get in just fine, just tell me when to get out. Now, oftentimes that person also doesn't want to nail down a specific rule for getting out, okay? They're saying, well, I just want to hold it until it stops going up, right? I just want to hold it. I want the stock to go up and I just need to let me know when the stock's going to go down. Well, and then my comment is, well, down for a day, for a week? Well, how much are you expecting this thing to go down, right? At what point are you wanting to cut it loose? This comes back to understanding your holding period, right? What type of holding period are you targeting? But sometimes, again, that irrational side takes hold, right? But we got to know our exits. But I'll tell you that sometimes we perceive that we know when to get in, but again, we may have a sense of when to buy. But again, if we're buying the wrong kind of stock, we're not necessarily putting ourselves in a position to be successful, even if we have a good entry, because that exit's not going to work because I picked a stock that doesn't have the same kind of trend potential that other companies have or volatility, okay? So, and I'm asking this question, I'm sure it's painful right now. The market just went through a decent correction. How many of you have had some nice profits only to give them all back and then some? I mean, the fact is, if you've ever traded anything, you're going to have this happen, right? Stocks gap, they can do other things where you have some good profits and you give them all back. But the problem is sometimes we find ourselves in a position where we systematically do that. We systematically buy, the stock goes up, we have some nice profits, it starts to correct, and then what happens? We just don't know when to get out. In fact, recently, I mean, this happens quite a bit, right? Stock's doing well, it's going up, it begins to break, right? And it drops. And right here, you're saying, okay, if it can just get back to here, if it can just get to there, I'm done. I'm going to get out of it. I wished I would have sold here, wished I would have sold maybe up here, but you're saying if it can just get back up, I'm going to sell there, right? Then immediately the stock starts to turn around. And what's the next thought process? Okay, you know what? I'm glad I held, right? Because the stock's going to go up, and all of a sudden you become encouraged. For that moment, you think the stock's going to go right back up again, right? It may even get to that point. You're saying, well, I'm not going to sell there, right? Because this is a good company. And then what happens? Maybe it gets there, maybe it doesn't, and then the stock rolls over. And then you're saying, oh man, I should sell here, right? Well, I don't want to sell here. If it could just get back up here. I realize it went up before and I didn't sell, but this time I mean it. And then what happens? Then the stock breaks support and goes down further. Okay? And then all of a sudden you hit that point of despair where you're all of a sudden apathy. You're like, well, I may as well just hold it now. Right? We can play these emotional games. But if we want to be successful, we got to get out of that. Right? This is kind of the irrational behavior. This is the emotional behavior. We got to think systematically, okay? And hopefully some of the things we're going to talk about today and then our class on Saturday, we're going to dig in deeper. We're going to give you some of those things to help you know when you should pull the plug, right? Treat it systematically. There's a saying I've said for many, many years. It's better to take smaller systematic losses, maybe more frequent, than taking larger unsystematic losses. Those are way easier to cope with as a portfolio and emotionally, okay? So let's talk about proper position sizing for a moment, okay? Number one, you got to manage your asset allocation. The fact of the matter is that, this is a big deal, right? I'm sure a lot of you guys are in here and you're saying, oh man, I wish I could have come up with a better title than how to trade growth stocks, right? But it's descriptive. I wanted you to know exactly what we're doing today, right? But the thing is, when we're managing our asset allocation, this is extremely important. I'm sure a lot of you guys say, well, why would I ever buy stock? I don't know how many times over the year people are saying, why would I ever buy stock? Why wouldn't I just trade options? Okay? Options are great. They're fantastic for leveraging yourself, for managing risk and other factors, right? Other things. But the fact of the matter is, if you buy, let's say you're buying a growth-oriented company, you might have maybe 30, 40% potential return on a typical stock in a period of about a week to maybe a few weeks to a couple months. Sometimes things go more than that, right? Let's just say on average, it's around that 30 to 40% return. Well, someone might say, well, yeah, but I can do this spread for a week and I have 100% return potential. Yeah, but if you're wrong, you have 100% loss potential in that week. Would you want to have all of your portfolio in a situation where you have a chance of losing 100% of your return in a week? Probably not, right? We got to spread it around a little bit. We have to allocate our capital, our assets, so that we have some in a basket that can leverage itself, that you can capture some of those 100% gains in a week or a month. Not to say you can't get those 100% returns sometimes in a month, right? Trading the right kind of companies. But the point is that we have to manage our asset allocation. We can't have all of our proverbial eggs in one proverbial basket. We got to spread it around, right? I may have 30% return potential, but I do not. The chances, well, think about it for a moment. What is the probability of taking 100% loss on a stock? What do you think? What's the probability of taking a 100% loss on a stock? It's virtually zero, isn't it? There's virtually no chance. There is a small one, right? Low, 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 Sylvain says, right? Yeah, very, very small probability. That's a good thing, right? Stock like Proctor Gamble, except for, the flash crash, but they broke all those trades. Stock like Proctor Gamble, highly unlikely, right, that stock's going to go to zero or even see a significant decline, maybe 30 to 50% in a bear market, right? Other stocks could go down more than that. But anyway, we also have to manage the amount invested in a single trade, right? We're position sizing based on the amount of risk. But the problem is we got to make a decision, right? Sears, yeah, well, there's the writing on the wall has been in Sears for a long time, right? But manage the amount invested in a single trade, right? We're going to give you some ideas about how to set that risk point, right? Where you say, okay, at this level, I'm done, okay? You may even set an automatic order to sell at a market or a limit. Guess what we call those? Stop losses, okay? So the point is, management of the investment in a single trade. Once you've defined that risk, guess what? Now you know how much to invest based upon your acceptable risk. Maybe you say, I'm willing to risk 1% of my account. Well, if you know the amount you're risking per share, and you say, I'm willing to risk $1,000, or maybe it's 0.5%, it's $1,000 or $2,000, whatever that is, it's easy to back out from that how many shares to buy, right? Because we don't want to be in a position where all of our eggs are in one basket. And like that gentleman that bought Apple, he was betting on Apple, right? There's people out there that are skeptical about investing. It's gambling. Well, no, it's not. When you bet on a stock, guess what? You're gambling. When you put all your money in one basket, in one particular egg or one particular highly leveraged strategy, guess what? You potentially are gambling. We're not betting on stocks, folks. We're counting on our system to be profitable. We're managing risk. We're evaluating the growth prospects of a company. We're doing our due diligence. We're not willy-nilly out there putting everything in one company or one very highly volatile strategy and saying, okay, I'm going to let it ride. Okay, that's not what we're doing here. Okay. So risk and success. How you handle your risk is directly correlated to your success in the markets. Okay. You got to have capital left over to live another day. Too much risk, you'll panic and close positions continuously the worst possible time. Over the years, I can't tell you the hundreds and hundreds of calls. People call up and they're panicking over a stock that's dropped 1%. So, I'm bringing up the stock and I'm saying, man, stock's down very little, maybe a couple percent, maybe 3%. And I'm saying, yeah, okay, yeah, it's down a little bit. And they're freaking out, right? Oh, what do you mean down a little bit? I mean, well, I know exactly what's wrong, right? They're too leveraged in that trade, right? Maybe they put a bunch of options on it. They're taking way too much risk beyond what they're comfortable with. If you want to take yourself out of a systematic approach to trading, put too much on a stock and see what happens. You're going to go to that least common denominator, right? Now, at least you're consistent with your panic. It can happen, right? But the point is, we want to make sure that we're managing our risk, which is going to lead to success. When you take a trade, you're looking at the risk number one before you're looking at the reward. Most people get it backwards. Most people never even consider the risk. We want to look at risk number one, then look at the potential return of the stock after. Now, we've kind of laid the groundwork. We've talked about what makes a successful strategy. But we don't necessarily know, okay, what is a growth stock? Okay? Anyone, show raise a hand or comment. How many folks have done kind of some growth style investing in your own trading stock? Anyone done that? Anyone doing that? Okay. Sylvain says, sure. Yeah. I say most of you guys are probably, whether you've identified it specifically as a growth stock, most people are attracted to growth stocks. Okay. Because they see the potential. Amazon, yeah. Amazon's one that's kind of dicey at times, right? When they're not making money and it can be hard sometimes. Okay. But let's talk about some of the characteristics of a growth stock. Number one, it's about earnings growth. Okay. It's about earnings growth. In this case, we're looking back 5 years. Now, a stock like Square, you're not going to have a 5-year, historical growth, right? You're not always going to have historical earnings growth. Okay. So, but again, we're looking at 5-year earnings growth of 15% or higher. Now, sometimes a company's gone through a period like in Amazon that's been unprofitable, right? And maybe it's because of other dynamics or considerations. We're reinvesting in the company. We're doing all these things to try to drive future potential growth. And guess what? Once Amazon, the pressure was on to actually produce some earnings, that's when the stock began to take off, right? It's kind of languishing for a little while because why? They weren't producing those earnings. Once they flipped the switch and began to turn the earnings back on and they began to show that they can generate growth, that's when the stock began to take off. And probably even more importantly is the future projected earnings. We want to see that, hey, that analysts out there that are following that company, that are providing their estimates for their company, we want to make sure that they're projecting this company is going to grow in the future. Now, analysts are historically more optimistic than what is generally actually attained. So what oftentimes is the case is that analysts start here, and then as we get closer and closer to that specific earnings, they tend to ratchet it down as they get more in line with analyst estimates, okay? When we talk about revenue, one of the things is sometimes companies can have very, very high projected earnings. But sometimes it's because if you start with a zero baseline, any movement to the upside to to profitability is going to lead to very significant earnings gains, okay? We want to make sure the revenue's there. Yeah, they may have for a while maybe had some factors that led to earnings declining a little bit, right? But the one thing that we want to see is that the revenue is growing, right? This company is expanding. It's getting more and more, it's selling more and more widgets, right? We want to see that that growth is not significantly less than the EPS growth, okay? Now, on Saturday, we're going to talk about some specifics in terms of what we can look at, and we're going to go through a lot of examples of beating analyst estimates, right? This is an important one. Does anyone know what percentage of the time do companies beat analyst estimates? So we're just entering. A lot of the banks announcing earnings this week, right, and last week. Okay, banks are announcing. We had Morgan Stanley, Goldman Sachs today. They announce earnings. And every earnings season, you'll see people on TV reporting what percentage of the companies beat estimates. Okay. Now, last earnings season was actually really, really high. Okay. We've had some reasons for that, the tax cut and other things. But on average, what percentage of the time do companies beat estimates? Does anyone know? What's your best guess? Sylvain says, don't know. What's your best guess? 25%? It's quite a bit higher than that. Since Reg FD, yeah, Craig Emptyfield, no, sorry, Craig. Craig got it, 70%. Todd, about 70% of companies beat estimates every earnings, okay? The lowest since Reg FD was basically Lehman Brothers, and I think it was around 54% of companies. So the worst quarter we've had since Reg FD in like 2005 was 54% of companies beating, and that was in the middle of a recession, okay? Companies historically beat estimates at a very, very high rate. The companies are communicating with the analysts. Those analysts are guiding those estimates lower going into an earnings. So beating analyst estimates by itself is not a feat. How much they beat estimate is a feat, right? They're significantly surprising estimates, but also it's a matter of the direction of the estimate, okay? The direction of the estimate's important. Are we guiding lower into earnings? Or are we guiding higher into earnings? That's a big difference, okay? We'll show you a screenshot from Yahoo Finance so you can look at to see, okay, what's the analyst doing with regards to their earnings? Are they raising or are they lowering those earnings expectations, okay? And time flies when you're having fun, doesn't it? I'm having fun, are you? No. All right, who provides growth projections? We talk about this term analyst, okay? Analysts provide retail investors their projections for recommendations. These are sell-side analysts, okay? You have buy-side analysts that work for hedge funds and money managers, that sort of thing. They're not going to tell you what they think. But the brokerage side, they have sell-side analysts that do provide their information. They'll analyze good companies. They'll analyze companies by the analyze companies representing these brokerage firms and other firms out there. And they're providing their expectations, okay? Now, analysts provide, non-GAAP earnings projections, okay? And when we talk about GAAP and non-GAAP, GAAP stands for Generally Accepted Accounting Principles, okay? Generally Accepted Accounting Principles. So what this means is that there's certain accounting principles that the company has to operate when it reports its earnings. So when a company reports its actual earnings, it's GAAP, okay? But when you look at when it says, oh, so-and-so beat their earnings, they're talking about non-GAAP earnings, and they're reflecting the analyst's estimate for those earnings, but those are non-GAAP. Non-GAAP takes out things like non-recurring expenses, right? Maybe you have some write-offs or other things that are not going to be recurring on an ongoing basis. So we'll take that out. That's important, right? If it's a non-recurring expense, if a company wrote down a bad asset or an acquisition or whatever, you hate that to completely drop the earnings and then it distorts that picture for a long period of time. So using non-GAAP is important, right? But it also takes out things like executive compensation, which can be very dilutive to shareholders, right? And so looking at GAAP and non-GAAP is important. When we look at earnings projection, it's non-GAAP. We look at historical earnings growth, we're looking at GAAP. We get both those perspectives by looking backward and forward. And that data is typically available through your broker or through many free sites like Yahoo Finance, for example, right? I'm going to show you an example here. This is just a little snapshot from the analysis page on Yahoo Finance. And this is for Ulta Beauty, okay? Ulta has been a pretty good stock at various stages over the last little bit. We're going to look at the chart here to wrap things up in a minute. But as we look at it, we're saying, okay, what do we got? You can see these various earnings announcements, right? We can see the estimate. We can see the actual. We can see the difference in the percent that it's surprised. Right here in January 30, they missed analyst estimates. We'll get to see how that reflected in the stock. A growth stock that misses estimates can be very, very damaging. Right? I mean, has anyone seen that? You know, you're buying, you own a stock, it's going, earnings are coming up, and you hold through and the stock gaps 10% on you. Has anyone ever had that happen before? Yeah, this happens, right? Knowing how to address earnings is an important thing. In fact, you know, in my options club, we spent some time looking at, so I do Mondays on options. We kind of sprinkle options throughout the week, but personally, I do options on Monday. We talked about how to hedge your portfolio a few weeks ago. We talked about how to hedge an option, how to hedge a stock over earnings last week. We talked about how to trade earnings from an option standpoint, right? So options can be nice to sprinkle in, even if you own the stock. Maybe buy a put out there. Maybe sell some premiums so the put doesn't cost you so much and give up a little bit of upside. There's lots of things you can do that are going to basically help eradicate some of these negative surprises in those big moves. Okay? How you screen for stocks for earnings? Okay, so it's very, very easy. It's an earnings calendar, right? So there's different ways you can look at it. Number one, you can look at it and say, okay, if I'm interested in a specific company, and when I go to the platform here in just a minute, I'll show you. But if you have a specific company, it's easy to see when the next earnings are. Okay, but most brokerage platforms, thinkorswim has it. It has an earnings calendar. There's also a site called Finviz. Finviz is nice. It has a little on its news. It'll kind of filter out a lot of the bigger companies that have earnings announcements in the bottom right. But I'll show you on the site there, the calendar really quick, and where you can see an upcoming earnings. Okay. So, and a lot of screeners, even on thinkorswim, you can screen for that, just looking for companies with earnings specifically. Okay. But what we're focused on with this, we're not so focused on trading companies for earnings as much as we're trading a stock that may happen to have earnings. You may get some buy signals this week to get in, but it has earnings next week or 2 weeks. What do you do, right? Again, not our focus today, but again, as you dig into options, again, some of my classes, we focus on those kinds of things to manage risk as we go along. So as we look at this is our 5-year growth example. Oops, that was a bad line. There we go. Well, let me redo this. That's pretty easy. 5-year growth example, okay? Again, using Ulta, next 5 years, projected growth at 20.32%. Past 5 years, growing earnings at 28.95. Now, again, next 5 lower than past 5, right? Companies mature, they expand. I'm sure you've probably had an Ulta built in your city or neighborhood or whatever the case is. We just had one built a few miles down the road, right? It's expanded tremendously, and as a function, its earnings growth is going to slow a little bit, right? But again, 20% growth projected for the future. We got next year, current year, again, all in double digits, all greater than 15%, right? This is very, very characteristic of a company that's growth-oriented, historically and projected. Apple's a company that had some issues in the past, right? It had a period of time where its earnings declined 10% in a year. They've been buying back stock furiously to increase that earnings per share. But recently you've seen that uptick in growth where sometimes companies can resume that growth trend. So we do place more emphasis on the next 5 than the past 5 as a general rule. Other considerations, we'll probably expand a lot more fully on Saturday, but management effectiveness, okay? This is extremely important. I can't tell you how many tech stocks have come out over the last few years, Twitter, Tesla, right? Where their concern for shareholders is about nil, right? They're gobbling up significant amounts of the company's revenue and earnings in executive compensation, leaving very little left over. There's some measurements for gauging management effect. There's some measures for gauging management effectiveness. Also, another thing is that you want to make sure a stock's in favor, right? We want to see that the company is, from a market level and industry level, that it's relatively outperforming. When you're trading a stock for appreciation, we'll get more deeply in this on Saturday, how to do this, but specifically, you want to see that a company that's outperforming its industry, and its industry is likely outperforming the market, okay? That kind of dynamic shows that there's money flow, right? We want to see institutions moving their money into a specific space, into a specific stock. It can be a very tough road to hoe if you're trading growth-oriented companies that are out of favor, because what's happening, those projections for future earnings are starting to slide, and that company's starting to go down. Another factor you could consider, we're going to give some specific criteria on this, is short interest. Does anyone know what short interest is? Anyone use short interest in your analysis of a stock? Anybody? Short interests are your buyers of last resort, okay? Tesla at one point, when Tesla made its massive rally a few years ago, guess what happened? 40% of the stock was shorted. When those shorts go to run for the door, it can create tremendous potential. I kind of look at short interest as like a life jacket, okay? So for those who are not familiar with short is, a short is somebody that sells a stock first and buys it back later. They're selling a stock they don't own. So when you open a margin account with the broker, right, you give them the approval to lend your shares out, right? So if someone wants to short a stock, they'll borrow it from the broker, they'll sell it at the current price with the intent of eventually buying that stock back and giving it back to the broker, okay? Short interest is like a life jacket on your stock, right? When you see the market decline recently and you get this sharp kind of spike at the bottom, a lot of people call it a dead cat bounce. What's causing that? The buyers down here at the very, very bottom, they're the shorts because they sold up here and they're buying back here and they're taking their profits, okay? So some consideration for short interest is relatively important, right? And the way we measure that is the number of days to cover and in the percentage of the open interest, okay? So again, something you might consider as a bonus if a stock has a relatively high degree of short interest, okay? And it's trending. That's kind of a perfect combination, right? Valuation. There is a point, even for growth stocks, where valuation can become compelling, right? In terms of creating scenarios where all of a sudden, you know, a company just sneezes and it drops substantially. Again, if any of you folks held a stock over earnings and you're like, wow, it's been doing great, and all of a sudden, boom, the floor falls out of the bottom of the stock. Valuation's probably part of the reason for that. But I got to pick things up here. We got about a few minutes left. Net profit margin, those things to consider in terms of management effectiveness. How much money are they making on their revenue? Their net income divided by the revenue. Return on equity. This equity is what you as a shareholder, as an equity holder, you own equity in that company, right? Is there equity for you? L Brands, for example, we're looking at this last week. We analyzed it. There's no equity in the company. Their liabilities exceed the assets in the company. Is that a stock you want? A company that has negative equity? Probably not. If it goes through liquidation, you'll have nothing left over, right? So equity is important to have in a company. We want to see return on equity in double digits, probably close to 20%. Leverage ratio, right now, risk is increasing. Why? Borrowing costs are going up for companies. A highly leveraged company is a company that also presents risks, okay? Now, at times when things are smooth sailing, when borrowing costs are low, leverage can actually expand a company's return. Right now, consideration for leverage in a rising interest rate environment is something to consider right now, okay? How to trade growth stocks. So growth stocks provide higher potential rewards and risks, okay? We got to make a determination what the trend is, both the short, intermediate, and long term. We have to define our entry exit and manage risk, as we just talked about earlier, okay? Short-term trends can be identified using a 5 to 10-day moving average. A very common one is a 10-day exponential moving average to gauge the short-term trend. So a close above a 10-day exponential moving average would be an indication of a short-term uptrend. That could be a potential entry. Intermediate-term trends close above the 20-day. We'll talk more about why these might be used on Saturday, but intermediate trend close above the 20-day could be an indication of an intermediate-term uptrend. And a long-term trend, we're using 100 to 200-day moving averages to gauge the longer term trend of the stock, okay? Now when we're trading growth stocks, long term can be a horizon that may be too much, okay? Long term, you might be looking for your exits once a week. How much can a growth stock go down in a week? So we talk about giving back a lot of your gains. A lot can happen in a week if your exit's based on that weekly close. With most growth stocks, you're probably, again, looking at it mostly daily, but your exit's going to be based on a daily time frame typically, okay? If we're looking to manage risk, swing trading, we're probably looking at short-term trends. We talked about the 10-day exponential stops 1 to 2 times the ATR. ATR stands for average true range. Okay, it's the difference between the open to close, sorry, the high to low, or the difference between the previous day's close to the next day's high and low. It's called true range because it's incorporating gaps. Trend trading on a daily chart, we're going about 2 to 3 times the ATR. We're giving it more room so we can stay in the trade longer, okay? So we're gonna quickly look at a chart here. Sorry, I'm a bit over time. Don's gonna be shooting me here. We're gonna look at Ulta, okay? One way to look at this, okay, is by using different indicators. We saw what happened in January, right? Ulta missed its earnings, okay? We missed the stock decline. Oh, Don says I'm okay, explain away, all right. We missed. We saw that, right? As far as Q1, Q1 might be back here. I can't remember which is Q1. Probably, it might be back. Anyway, we missed in Q1, right? The stocks were declining. Recently, maybe on a mend. You can see the trajectory a little bit here in terms of earnings, right? As we go forward. Now, this is the kind of company that typically has a lot of seasonality, right? That first quarter is big. Why? We're incorporating those earnings in December. Okay, so when we look at this, we see, okay, is it increasing year over year in the same quarter? Yeah, we can see that, right? We're increasing. Projected increase coming in the coming quarter. We can go back to that chart. We can see that, okay? Recently, though, it's had some struggles. It's missed 1 out of its last 4 earnings. Ideally, I like to see a company that's beat its analyst estimates in the last 5 quarters, at least the last 4, okay? We can see we've had some misses, and so the stock's been a little more ugly. At other times in the past, it's done significantly better, and it's had periods where it's trended very, very strongly. Now, applying what we've learned, I'm going to come up to the studies. I'm going to show you a study here. It's incorporating both ATR and a moving average. It's called the Keltner channel, okay? So we're going to come down here at Keltner channel, and we're going to change how we apply this. We're going to click the adjust settings. We're going to go to ATR because we're going to focus on an intermediate term trend trade, something that might go weeks to months, probably on average about a 2 to 3 month holding period. If you want to put that in the back of your mind here, regardless, we're going back 20 periods, okay? We're going to use the closing price, and we're going to change our average type to exponential. What this means is we're weighting the most recent price action. So if we're seeing a big change most recently, it's going to weight that versus the price 20 days ago, okay? And we're going to leave our true range type as simple, and that's going to be focused on a 14, I think it's still focused on a 20 period, which is fine, okay? Encompasses typically an entire cycle of going from down to up, from a low to a high to a low. And I'm going to throw this in here. Okay, we're also going to add another indicator. I'm going to come down to moving average. All right, sorry, simple moving average. Okay, and on this one, we're going to do a long-term moving average. It's generally important that we're trading not only in the intermediate-term trend direction, but in the long-term trend direction. I'm going to throw in a 200-day moving average here. And lastly, I'm going to look at moving average of the volume. Okay, look, volume type dynamics are important. It tells you if people are buying or selling, right? If we see high volume and the stock goes up, it's an indication of buying. Higher volume, stock goes down, it's an indication of heavier selling, right? Helps us give us that kind of that. If you think of axes, right? You got your y-axis, your x-axis, which is your price chart, price and time, but volume gives you that kind of third axis, your z-axis for those engineers out there, okay? Length on volume, we're going 20 periods, okay? Encompassing basically 1 month of trading. Now, as we look at this, well, how would we do this? How would we use this? You'll notice right here that Ulta began to cross above the moving average, the 200-day moving average in blue. Okay, we began to see that shift, and then all of a sudden, pop, we get an earnings announcement. Okay, so at this stage here, we're beginning to trend. Do you buy right before the earnings? Maybe not. You might wait till after. Oh, I missed it. So what do? Now you can wait a little bit, right? You see that we failed. We kind of pulled back here. We came back to the 20 period exponential moving average. We came down here to lower Keltner channel. Right here is basically your -2 ATR. Okay, we're taking 2 times the daily range, true range of a stock, daily true range, or up here we're talking about +2. We're not using the upside quite as much, other than to gauge maybe overbought conditions, right? What we're looking at is a point where the stock's crossing above the 20, and our stop is going to be at the 2 ATR lower Keltner channel, okay? So right here we get it, right? Stock closed above. We get some volume, indication of buying, right? Institutional investors coming into the stock potentially. Our stop's right here at the lower Keltner. We've defined our risk now, right? We know when to get out. We know when we're wrong. Then the stock starts to go up. We can just continue to bounce along, trading along until right there, right before the earnings. What happens? We close below it. In fact, we sold off on some higher volume as well. You might decide to just close it right there, not being willing to hold through the earnings. You did okay. You're probably up about 10% at that point. You might consider taking maybe 1% of the purchase price of the stock or the current price of the stock, maybe buy a put out there for it over the earnings. Really short term, just to take away that gap risk, which can happen. We saw a big gap here. Okay, maybe you carry it through. Well, the stock meanders higher, eventually closes below right here. What do? Move your stop up. Okay, stock runs back above. Well, if you missed it back here, maybe you get right back in here. Okay, stock runs. Well, you close below again. What do? Move your stop. Runs up. Oh, we close below it again. What do? Move our stop. Runs again, keeps running, keeps moving forward. Kind of run through this one scenario here. But again, this is what happens when a stock trends, right? And these stocks can trend for long periods of time. Why? They're beating analyst estimates. Analysts are upgrading their perspective or growth prospects for the company. It continues to move higher. And as we see these points where we're faltering, we're moving our stop up until eventually what happens? Now you break it there, your stop's there. You break it again, you move your stop there. Well, this trend keeps on going. This one lasted way longer than expected. Well, eventually what happens? We can move our stop up. We close below. Here we have our stop there. We close below it again. We move our stop to there. Here's a day right before the earnings. We sell off on extraordinary volume. That is a big sign, folks. You might decide right there to sell. See what happened the next day. The stock traded significantly lower than rallied again, right? You get a big down day like that on extraordinary volume, you're probably selling on that or doing some hedging strategy to mitigate the risk, okay? So boom, we get out or we get stopped out the next day, okay? You do a stop limit, you're not no trouble. Your stop's right, stops right there, but we're sitting basically on top of it. You may as well just sell, okay? But if you didn't do a stop limit, you don't get hit by that. I'm not sure why. It seems like it'd be more of an earnings move right there. But anyway, you kind of get the point, right? A couple of indicators that says, look, you know when to get in, closing above the 20, maybe see a bump in the volume. We're running through a lot of examples here on Saturday. We're gonna spend an hour just on this part of it. But again, knowing when to buy, when to sell, when to adjust risk, right? Maybe some points on, what do I do over earnings, those types of considerations, okay? So that's a little bit of what we're gonna be going over this Saturday, okay? All right. So why doesn't everyone do this? Okay, here's what you need to know. You got to know what stocks I trade this on, right? You got to pick the right kind of company. We got to know how to analyze the growth prospects. Is the stock I'm trading in favor with analysts and the market? Is the management team effective at generating returns for equity holders? Is there any equity for me to be, do I have any piece of the company? Is there any equity? Very easy to see. It's a big red flag if it's not there. When do I enter? When do I exit? When do I sell? When do I exit? When do I sell? Is a little bit of a distinction. We talked about a difference when you're moving your stop and selling because why? We broke through the 20 on high volume. Okay? So again, it's been a pleasure being with you folks here today. It's kind of the end of our presentation. Don's going to take over here in just a second. Hope this has been helpful, giving you some ideas out there, right? Some things maybe percolate in the brain. Such a tease. Yeah, I'm sorry.
You know what? So I just hopped on here, and I'm actually going to take everybody through a little bit how, of course, they can attend the Saturday class. I mean, there is There's a huge amount of criteria in this. And by the way, I love now, man, that you're on board. This is an area like at TheoTrade that we just lacked. I mean, we lacked in terms of like this fusion between technicals and, you know, fundamental background. And by the way, if this is the first time you guys have attended here, this is a lot of criteria. I mean, make no two ways about it. You know, you're going to have to give Brandon, you know, almost three and a half, almost 4 hours of your time to go through some of that. And that's kind of what I'm going to bring up right now. What we've constructed, you know, for this class and what we do basically for all classes is criteria. It's kind of what we do. We are going to go through and we're going to have Brandon systematically, and by the way, the entire class is constructed. Brandon is, you know, hard at work just wrapping up obviously a couple things on it, but you know, trading becomes all about answering the what ifs. He's going to give you a good stock candidate, okay, for trading, swing and trend trading, you know, how you can understand what analysis, okay, or, you know, analysts, I apologize, are telling you specifically about the stock, other considerations that makes the stock and the underlying move. Where do you go to find the information that you need? Clearly, he was giving you a couple of different places, but we're going to get into the specifics because a lot of the questions that'll come up, again, during the class is going to be, well, can you scan for this? Can I make this a little bit easier? Sure, why not? Okay. What should I do when a company announces earnings? Run! If it's Netflix. You know, this is what we do during these classes. We have the answer to all these questions. We give you the right stocks. How many shares should I buy for the account size, which is allocation? When do you take profits? You know, when do you stop limits? How should I actually go about protecting it? What are the indicators I can use to analyze, you know, everything down, okay, everything down to the science of what if a stock goes up, what if it goes down, what if it stays flat, all right, how to actually analyze these. That's what we do. We have the Theo Trade, you know, answers to those questions. It's just recipes. And for those of you, if you've ever been to one of our courses, we literally build step by step. Step one, this is what we're going to look at. Step two, this is what we're going to look at. And we look at all the different variables. We actually look again, what if a stock goes up? What if a stock goes down? If there's a catastrophic move? And people, listen, there's a lot of different variables that can happen to you. This is not just about finding that perfect needle in the haystack. It's about what to do, okay, when you're in and have already found the perfect needle in the haystack. And that's where people have a difficult time. So all the different variables, you know, the how, the when, the why, at what price, it's just the beginning, though, of the variables you're going to face when trading. We always say the secret's in the sauce, okay? And it is. You know, you could read about growth stocks. You could read about charting. You know, think again, this stuff took years of his experience. In fact, again, the group that Brandon worked in at TD Ameritrade, this is what they did, all right, for what is the largest retail brokerage firm on the planet. This is what they did. This is his bread and butter, this fusion between technicals and fundamentals. And again, this is the curriculum for the class that we're going to be hosting this Saturday. And yes, the class is recorded. Somebody already, okay, asked the question. I'm going to show you that here, but I wanted to take you through the curriculum before even showing you the time, everything about it. You're going to learn a systematic approach to analyzing the fundamentals of a growth stock. Key identifiers of a growth stock from a fundamental, okay, what we call kind of triple threat position. It's an interesting perspective to, you know, when he talks about the triple threat, well, he's going to get into that and clarify specifically that during the class. Leverage the power, okay, of analyst estimates. Listen, I have no love, nor does Brandon, for any of the analysts, okay, but they move markets. Okay, their estimates and revisions move markets. Understand the different types of earnings that are reported by a company. Okay, are they going to be EBITDA? Is it GAAP? Is it non-GAAP? It's a party when you get to that section. Learn how to compare a company's performance with its industry and the marketplace. You got to recognize how convoluted things are with the new accounting procedures. So going through and comparing one company to another, even in the same industry or sector, okay, can actually be a little bit of an arduous process. He's going to break that down for you. Understanding short interest and specific criteria to propel a stock. This is always an interesting one because short interest, people don't recognize. They're like, I can actually, I can make a stock explode. okay, to the upside. Learn the trading system to use growth stocks, including entry, exit signal, okay, and risk management. Trades can be done with the trading account as little as $2,000. You can do this in all different types of accounts, whether it's your IRA, okay, whether it's a 401k, if you have like a self-directed 401k, or regular taxable account. The class, as we said, it's how to trade a growth stock, okay? The trade instructor for this course is Brandon Chapman. It's live this coming Saturday, October 20th, 10 a.m. to 1 p.m. I'm going to suggest that you leave a little time extra on here because he's probably going to run over. I think it's going to be beyond a 3-hour course, but we kind of have the belief here at TheoTrade, we'd rather overwhelm you rather than underwhelm you. The course slide deck that includes all the entry and exit criteria, which is the checklist, that's available on October 20th, the morning of, for download. You'll be able to download it. The course will be archived immediately following, okay, each portion of the course. The course itself is $199. The course and the class qualifies you for a reduced commission rate. We've got reduced commission rates if you have an existing account, for instance, TD Ameritrade, or if you have an existing account at E-Trade, we have a reduced commission. We cannot and will not mention that live. If you chat in, I can tell you what the reduced rate is. If you do not have an account at those brokerage firms, we will give you a link to the account, okay? And in the account opening process, we can open an account through, okay, our link, and we will give you, of course, the reduced commissions rate. Now, this evening, okay, we have a little bit of a discount for you regarding taking this Saturday course. Now, kind of my feeling about this, and maybe yours too, but you've been through so many different courses and people are charging you $1,000 for this and, $10,000 for that. And I say $10,000. People, I'm not joking with that. Brandon actually wrote, okay, the book for a course, okay, through one of the subsidiaries of TD Ameritrade. And it was an 18-month program, okay, and that program cost, okay, over $20,000. And he's the first one to tell you, we do more here, okay, for next to nothing. And people always kind of feel like they've been there and done that. And, you've been through the gauntlet of paid classes and indicators, and people get secret squirrel black boxes. It's like, it's a secret indicator. Buy just this one last thing. It'll make all the difference. But wait, there's more. And they're constantly pressing you for more and more and more. And at the end of it, what have you done? You spent $5,000 and have absolutely nothing. We've had enough of the educational garbage, the sales pitches, and we're trying to put an end to it, disrupting financial education. What we're going to introduce to you this evening is what we call Total Theo Unlimited Streaming Monthly Membership. And what we do, basically, we are now the Netflix of the financial industry. So what does that really break down to? Well, unlimited, it's $99 a month. What does unlimited give you? Well, first of all, it does give you full access to the course that is coming up this Saturday. For $99, you have access to the course. In addition to the course, all of the criteria, everything, okay, that entire curriculum we went through is available to you this Saturday. It's $99, okay? In addition to it, you also have access to all of our archives. There are 76 trading classes in all. All are available immediately. There's 76 in the archive right now. Now, yes, there's a live class coming this Saturday, but you also have access to everything that we've done, okay, prior to this. Everything that we've done. There's also new monthly classes. There's a live trading room. People want live trading? We got live trading. We don't hide from you, okay? We broadcast live 6 hours a day. Maybe you can't make it. You realize just the class this Saturday, okay, easily worth $1,000, easily. Okay, again, we've charged, much more for that in, again, our kind of prior life, at TD Ameritrade in the educational subsidiary. Now it's $99 a month. Okay, it includes live broadcasting. Whether again, you can be in the chat room all day. We trade throughout the entire day. Also, indicators. There are 59 proprietary indicators and scans available in TheoTrade. We email you out trade ideas. When we trade, we email it out to you. Okay, it's part of the $99 program. There's daily coaching sessions with timely topics, stocks, options, futures. Okay, every single day. Brandon's in the chat room. He does 1 hour, 5 days a week. He does 1 hour, 5 days a week, taking you through exactly the kind of stuff that we're talking about. And we actually answer emails. The instructors will answer the emails. It's theotrade.com/growth. Stop right there for a second. Do you think it's worth for 99 bucks, okay, if they just answered one question on an email, okay, in a month that got you out of trouble? It's going to be worth more than $99 to you. And that's where people they don't get it. They're like, well, what don't you get? 99 bucks a month. Why do you think we keep adding instructors? Why? Because we have almost 3,000 clientele on there. Have to add instructors to be able to answer the questions, be able to come up with timely topics. We're constantly adding them, okay? Now, I want to just take you through this for a moment. And then, again, I'm going to bring you directly to the site. We have the Beginner's Guide to Swing Trading Growth Stocks. You can enroll for it for $199, which is a one-time fee. It will give you the Beginner's Guide to Swing Trading Growth Stocks. Or, okay, you can have Total Theo Unlimited Streaming. It's $99 a month. That includes the Beginner's Guide to Swing Trading Growth Stocks. It also includes 76 classes, new monthly classes, live trading and chat room, everything archived, email trade ideas, okay, daily coaching sessions, email support, you name it, you got it. Why do we do this? People are like, why at $99 a month? Okay, first of all, why would you want to pay $199 when you could have everything for $99 a month? We're trying to give you $100. Why? Because we're so sure that you guys are going to love it, okay, that we want you to remain members. And by the way, this is a membership. It's $99 a month. You can cancel anytime. People always ask this question, like, can I cancel anytime? Yeah, it's not a yearly membership. It's $99 a month. You're like, you don't like us? Okay, I like you. We can part ways friends. It's still okay. Like, I get it. Maybe it doesn't fit you, but we have a lot of different genres of trading. I'm going to take you to the site right here in a second. But before that, what our members are saying, the archives of Theo Trade are a godsend, okay? You can, stop the tape, reverse the tape, make notes, use the information. Our archives are like second to none. Theo Trade topics and content really on target, really getting a lot out of the classes. My trading results are improving thanks to Theo Trade. Keep up the great work. Awesome. Finally, just to say, I'm really enjoying the experience with Theo Trade. The content you and the team presenting is on the ball. In particular, I find the entry and exit criteria you provide for the strategies during the classes very helpful. That's the reason I just threw this up here, okay, is all the different classes. It's theotrade.com/growth. Now, let me actually pull up the web page itself. That is the web page, okay? Here is the link. If you need the link, this is it right here, theotrade.com/growth. Go there. All you have to do is click right on here, add to cart. Again, so everybody knows we're here to answer some questions right now. If you want to chat with us, we're here. What does that mean when we're here? Well, you can actually chat with us if you want to. If you have any questions, you can also chat in. So let me go through a couple of things right now. By the way, right here, the add to cart, it's $99 a month. That's the unlimited monthly streaming. Why do we put them both on here? Listen, some people are just like, I don't want to sign up for anything $99 a month. But here's, the argument I have for you. Well, you can sign up for 99 bucks a month and then cancel after 2 months, and you're pretty much at even. Oh yeah, and you have the archived everything. If you want to see what the archive looks like, well, I'm going to take you to that. So while you guys are cruising over to theotrade.com/growth, it's GROWTH. I'm actually going to show you what the site looks like. This area on the site, let me hit F11 here so you can actually see it. This is actually where we broadcast. This is the chat room. Funny thing is, the chat room, they're active right now. That's tonight. That's now. I'm on Pacific time. So that's right now. People are still talking in here. During the trading day, okay, there'll be, in and out, a couple thousand people throughout the chat room. Gets a little chaotic, but this is actually where our presenters are streaming their screens to you. In addition to it, we post trades at the top of this. Now, moving right along, if you want to know what the archives look like, because you're like, I can't sit there, Don, for 6 hours a day. Totally get it. You want to know what the archives look like? This is the class archive. What do you want to know about option strategies? Are you a newbie? Technical analysis, day trading, trend trading? Told you, we hired the best in the genres of trading. Jeff Bierman, market technician, guy's unbelievable, unrivaled. Slim Miller, mindset and trading plan. If you have like psychology needs, he's there for you. Okay. If you're into quantitative stuff, option strategies, it's me. If you're into market neutral, you just want to learn to sell premium. Okay. It's Matt Williamson. I mean, I can go on all day. If you want, to scalp S&P futures or Nasdaq futures, yeah, we got Tony Rago. Okay, we have something for everybody. If you want to know what the option strategies look like, that is the, I would say this is the pinnacle of our entire database right there is the option strategy courses. You know, what does that really amount to? Sell premium, iron condors, high probability, covered calls, risk twist spreads. Are you overwhelmed? Good. Now you realize what you're getting for 99 bucks a month. Okay. By the way, all of this, you're like, I don't even know where to start. We have a start here menu. See it? It's right there. Start here. Because you're like, I'm overwhelmed. Good. Start here. These videos are not that long. It'll actually take you through the how, the why, the when. Okay. Get you up and going. But maybe you are a little bit more advanced. Guess what? We also have searchable. Totally searchable archives. You can type in anything you want. I want to know about iron condors. I want to know everything there is to know about iron condors. All you got to do is type it in there. Duration iron condors, duration iron condors. We got how to set up and manage long iron condors. There's short iron condors, low probability iron condors. Okay, you name it, we have you covered on that front. Now I'm going to answer a couple more questions in here. I'm going to throw the web address up there once again. Again, this is theotrade.com/growth. And yes, it does give you access. Okay. It does give you access to the beginner's guide to swing trading growth stocks, the course, even at $99 a month. People always ask us, what are you not including for $99 a month? Nothing. Okay, it's kind of like the full Monty at 99 bucks a month. A couple of questions that inevitably come up. The first one, I've answered this 3 times already, but it's in the chat, so I have to answer it again. Is it a membership for $99 a month, and can I cancel anytime? The answer is yes. It is a membership for $99 a month. You can cancel anytime. Again, some people are vehemently against, memberships. It's okay. It's $99 a month. Okay. The worst that's going to happen to you, you get charged 99 bucks. That's it. Okay. Can you do the strategies that we talk about in an IRA? Absolutely. Okay. Consequently, if you ever have really detailed brokerage questions, I'm going to give you a little insight. Jeff Bierman, myself, okay, Brandon Chapman, all worked the largest brokerage firm. I actually worked, okay, in the trader group, which was like the thinkorswim group. Jeff Bierman, he actually ran a portion of the trade desk there. Nobody knows the answers to those questions better than us. We can answer a lot of your brokerage related questions, no matter what broker deal you're at. Actually, one of my closest friends, okay, she now runs part of E-Trade. One of my other best friends actually, runs another major brokerage firm. It's a small world after all. Another question came up. I can't get approved for options. We can help you get approved for options, but that's something you got to email us on. If you're like, I can't get approved for options because I don't have experience. Well, most of the brokerage firms consider TheoTrade experience. That is very, very important to us. Okay. Day trading margin rule. We can talk about that a little bit too. It helps you kind of circumnavigate that. By the way, again, another question came up about recording these classes. Everything is recorded. We do every second of every single day at TheoTrade, 6 hours a day. Now, nobody expects you to go back and review 6 hours a day. Some of it's just live trading, but we do host coaching sessions each day. And those coaching sessions you might want to review. They're about 45 minutes long. So by all means, and by the way, thank you, Brad. He was saying best deal on the planet. And I think you guys will really find that. By the way, if you're in Canada, I can suggest alternative brokerage ideas if you're in Canada or Australia, okay, or the UK, okay, or Singapore. In fact, I know, Asian markets very, very well. I helped open the office in Singapore. So again, if, by the way, if you're working full time, do you have time to be able to do this? Yeah, actually, Brandon's class specifically, okay, I think it's very, very hands off, and almost all of the analysis from Brandon's class can be done in the off market hours. So with that, I'm going to stay here for a couple of moments. Okay, I'm going to answer a few questions in the chat room by typing in. Again, please go to theotrade.com/growth. Really enjoyed having Brandon kind of on board here. Can't wait. This is his first major class through TheoTrade, but known Brandon for years. We know his work. It's spectacular. You guys are going to love this class. Have a wonderful evening, everybody. Bye-bye.